Disclaimer.
If you're watching this on Monday morning, January 26th, 2026, you just woke up to 3 events that could rewrite the rules of American retirement. And if you haven't checked your phone yet, let me be the first to tell you what happened while you were sleeping. Gold just broke $5,000 per ounce for the first time in human history. Silver is trading at $109.50. And President Trump threatened our largest trading partner, Canada, with 100% tariffs over the weekend. Not 10%, not 25%, 100% on everything they send us. Now, you might be thinking these are 3 separate stories. A metals rally here, some trade drama there, typical Monday morning chaos. But here's what Wall Street won't tell you. These 3 events are connected by a single thread. And that thread is unraveling the very foundation of dollar-based savings that most Americans have relied on for their entire lives. Think about the timing for a second. Why today? Why this exact Monday morning? Silver didn't just randomly decide to surge past $109. Gold didn't coincidentally pick today to smash through 5,000. And Trump didn't accidentally choose this weekend to drop a tariff bomb on our neighbor to the north. Something broke. And I don't mean broke like a technical chart pattern or a resistance level. I mean broke as in the fundamental confidence mechanism that keeps our financial system stable. The mechanism that makes investors around the world say, yeah, I trust holding US dollars for the long term. That mechanism is experiencing what engineers would call a critical failure. Let me show you exactly what I mean. When you went to bed last night, silver was already climbing. But at 3:19 a.m. Eastern Time this morning, according to JM Bullion's live pricing data, silver crossed $109.76 per ounce. Most Americans were asleep. But in trading rooms from London to Singapore to Sydney, something was happening that should terrify anyone with a retirement account denominated in dollars. European investors weren't buying silver because they love shiny metal. They were buying it because, for the first time in generations, they're openly discussing using their massive holdings of U.S. assets as a strategic weapon. Think about that. Our allies in Europe hold trillions of dollars in American bonds, real estate, and corporate assets. And they are now talking about weaponizing those holdings in response to Trump's Greenland demands and tariff threats. You know what happens when your allies start treating your currency like a geopolitical chess piece instead of a safe haven? People run, not walk. Run to anything that can't be devalued by a presidential tweet or a NATO disagreement. But here's where the story gets really interesting. This isn't just about geopolitics. There's a hidden mechanism at play that's been building pressure for years. It finally reached the breaking point this morning. Silver is in its 6th consecutive year of supply deficit. That means for 6 years straight, the world has been using more silver than miners can dig out of the ground. Now, you might think, okay, 6 years is a long time. Surely the market would have adjusted by now. And you'd be right to think that. Except there's a problem. The usual adjustment mechanism, where high prices bring new supply online, isn't working this time. Why not? Because silver isn't just an investment anymore. It's become critical industrial infrastructure for everything our economy is betting on. Every solar panel needs silver. Every electric vehicle uses silver. The AI data centers powering our digital economy require massive amounts of silver for their electronics. And as America tries to compete with China in the green energy race, our industrial demand for silver is accelerating faster than our domestic supply can possibly grow. So we've got surging demand meeting structurally constrained supply. Economics 101 says prices should rise gradually until equilibrium is restored. But that's not what's happening here. Prices are exploding higher in a matter of hours and days. What gives? This is where the short squeeze comes in. And not just any short squeeze. According to recent analysis of the silver market, Wall Street banks and hedge funds had built up massive bets against silver. They were convinced that $100 would be a ceiling. After all, silver had never sustained prices above $50 in its entire documented history. 100 seemed impossible, so they sold silver they didn't own, planning to buy it back cheaper later and pocket the difference. But then something changed. China, which controls significant portions of global silver mining and refining, announced tightening export controls, not a total ban. Just enough friction to make global buyers nervous about future supply. Suddenly, those banks and hedge funds who sold silver at $70 or $80 or $90 are watching it trade at $109. And here's the brutal math of a short squeeze. When you sell something you don't own, your losses are theoretically unlimited. Silver could go to $200, $300, $500. Every dollar higher means billions in additional losses for these institutions. So what do they have to do? Buy silver right now at any price, which pushes prices higher, which forces more short sellers to panic and buy, which pushes prices even higher. It's a feedback loop, and we're watching it play out in real time this Monday morning. Now, let's connect this back to Trump's Canada threat. On Saturday, the president posted on Truth Social that if Canada makes a deal with China, quote, it will immediately be hit with a 100% tariff against all Canadian goods and products coming into the USA. End quote. Canada is our largest trading partner. They send us 60% of our crude oil imports, 85% of our electricity imports. They're our biggest foreign supplier of steel, aluminum, and uranium. Nearly 3.6 billion Canadian dollars worth of goods crosses our border every single day. That's 2.7 billion US dollars every single day. And we are threatening to cut that in half or more with tariffs because Canada is negotiating with China to lower barriers on agricultural products and electric vehicles. Think about what that signals to the rest of the world. It says America is willing to blow up its most stable trading relationship with a democratic ally that shares our longest border over trade deals with Beijing. But here's what really matters for your retirement account. When Trump threatened Europe with tariffs over Greenland, then backed off, then threatened Canada over the weekend, global investors started doing the math. They're realizing that the rules-based international order, the system where America provides stability and everyone trusts the dollar as the global reserve currency, that system isn't guaranteed anymore. It's contingent. It depends on staying in line with Washington's ever-changing demands. And if you're a European pension fund manager or a Japanese insurance company or a Middle Eastern sovereign wealth fund, and you're watching America threaten trade wars with allies, while its domestic politics become increasingly unpredictable, you start asking yourself a very simple question. Do I really want 50 or 60 or 70% of my portfolio denominated in dollars? The answer increasingly is no. And when those massive institutional investors start shifting even 5 or 10% of their dollar holdings into alternatives, that's trillions of dollars in selling pressure. You know what holds up when the dollar faces that kind of pressure? Gold, silver, real assets that can't be printed or politically manipulated. So we're back to this morning. Gold at $5,085, silver at $109.76. And the reason why now is becoming crystal clear. It's not one thing, it's everything colliding at once. We've got a 6-year structural supply deficit in silver creating baseline scarcity. We've got a massive short squeeze forcing institutional buyers to chase prices higher. We've got China tightening export controls at exactly the wrong moment. And we've got America's leadership creating uncertainty about the dollar's role as a safe haven asset through tariff threats against our closest allies. Each one of these factors would be significant on its own. Together, they create what market technicians call a melt-up. Prices don't rise gradually. They surge vertically as everyone tries to get through the same door at once. And here's the part that should keep you up tonight. We're only in the early innings of this. The Canada tariffs haven't even been implemented yet. Trump gave them until the tariff deal discussions conclude, which could be weeks or months. The Russia-Ukraine peace talks that happened over the weekend ended without agreement, meaning that geopolitical uncertainty continues. And the Federal Reserve is expected to keep interest rates unchanged at their meeting next week, which means real interest rates adjusted for inflation stay negative, which is rocket fuel for precious metals. Pop quiz. If you're a 58-year-old American 7 years from retirement, and you're watching your nest egg denominated entirely in dollars, and you're seeing gold break 5,000 and silver surge past 100, what should you be thinking right now? You should be thinking that the financial weather has changed. The old rules about 60-40 stock bond portfolios and holding cash in money markets, those rules were written for a world where the dollar was unquestionably stable, and America's geopolitical relationships were predictable. We don't live in that world anymore. We live in a world where the president can threaten our largest trading partner with economy-crushing tariffs over a weekend, and by Monday morning, precious metals are making historic moves that validate the market's growing nervousness about dollar stability. This isn't fear-mongering, this is pattern recognition. And the pattern we're seeing this morning is one that historians will recognize. It's the pattern that emerges when a reserve currency starts losing the confidence of global investors. It doesn't happen overnight. It happens in fits and starts. A crisis here, a policy shock there, each one chipping away at the assumption that dollars are the safest place to store wealth for the long term. The question isn't whether silver will pull back from $109. Of course it will eventually. Markets don't go straight up forever. The question is where it pulls back to. If silver corrects to 95, that's still double the old record from 1980. If it corrects to 85, that's still 70% above where it started this rally. The trend is clear, the direction is obvious, and the why now becomes more evident with each passing hour of this historic Monday morning. Your retirement isn't just about picking the right stocks or bonds anymore. It's about understanding that the currency your entire life savings is denominated in is going through a crisis of confidence. And the market is telling us that story right now through silver surging past $109, gold breaking 5,000, and our own government threatening to blow up critical trade relationships that underpin our economic stability. Welcome to Monday, January 26th, 2026. The day the rules changed while most of America was still asleep. Now, I know what some of you are thinking. This sounds dramatic. Silver has had rallies before. This could just be another bubble that pops in a few weeks. So let me show you why this time is mathematically different. Not emotionally different. Actually, structurally, fundamentally different. The Silver Institute documented in their November 2025 report that for 6 consecutive years, global silver demand has exceeded supply. We're talking sustained deficits, where the world consumes significantly more silver than miners can extract from the ground. For 6 years, we've been eating into above-ground stockpiles to meet demand. And those stockpiles are getting dangerously low. Industrial users who need silver to manufacture solar panels, electronics, and medical equipment are starting to panic about supply. According to analysts tracking physical silver balances, this deficit is structural. It's driven by massive expansion in industrial demand across sectors that define our economic future. Solar panel installations globally continue accelerating. Every panel requires silver for electrical connections with no efficient substitute. Electric vehicles use twice as much silver as traditional cars for electronics and battery systems. Major automakers like Ford, GM, and Toyota are pouring hundreds of billions into EV production. AI data centers require massive server farms filled with silver-laden chips and electronics. As companies race to build AI capacity, silver demand from this sector alone is exploding. Industrial demand is growing at impossible rates while mine supply stays flat. You can't just open a new silver mine overnight. It takes years. And most silver comes as a byproduct of copper and zinc mining, so supply depends on other metals economics. Growing industrial demand meeting stagnant supply, burning through inventories year after year. Eventually, the math catches up. Prices must rise. But before that happened, Wall Street made a catastrophic bet. Hedge funds and investment banks convinced themselves $100 would be silver's ceiling. After all, the 1980 record showed silver topping at $50. So they built enormous short positions, selling silver they didn't own, betting they'd buy it back cheaper. Except they miscalculated. Badly. They ignored the structural supply deficit, creating a floor under prices. Then China changed the game. Chinese officials announced tightening export controls on silver. Not a total ban, just restrictions, making it harder to get Chinese silver into global markets. China controls enough refining capacity that any restrictions create significant tightness. Suddenly, Wall Street short sellers faced a nightmare. Industrial buyers competing for limited supply. Investor demand surging, Chinese supply squeezed. When you're short and prices go up, losses are unlimited. So institutions must buy silver to close positions, pushing prices higher, forcing more shorts to panic and cover. It's a feedback loop. According to recent market analysis, the short squeeze has amplified silver's move past $100 and now above $109. That's the first piece of hard evidence. A structural supply deficit meeting a short squeeze. Documentable, measurable. Math. Now let's look at what happened to gold this morning and what it tells us about the dollar. Gold broke above $5,000 per ounce for the first time ever at the start of trading today. According to Trading Economics, gold surged to $5,085, up nearly 2% from yesterday. Over the past month, up 17%. Over the past year, up 85%. Gold doesn't normally move 85% annually. It's supposed to be the stable, boring safe haven. 85% is growth stock territory. What's driving it? Safe haven. Demand has gone vertical. Investors worldwide are desperate for assets that can't be devalued by government policy or political chaos. Gold's surge came specifically as Trump sought sovereignty over Greenland, unsettling markets days after walking back European tariff threats. Then he warned Canada all its exports could face 100% tariffs over the China deal. See the pattern? Threaten Europe. Markets panic. Back off. Recover. Immediately threaten Canada with bigger tariffs. Panic again. Each cycle, more international investors decide maybe holding dollars isn't as safe as they thought. This isn't about supporting or opposing Trump's policies. This is recognizing that unpredictability itself is a cost. When allies can't count on stable relationships. When policies change via weekend social media posts, that unpredictability gets priced into currency markets. The dollar's value isn't just interest rates and inflation, it's confidence. And that confidence is built on decades of America being predictable and stable. When that stability becomes questionable, gold at $5,000 is global capital saying, I'm moving wealth into assets that can't be politically manipulated. U.S. brokered Russia-Ukraine peace talks concluded over the weekend with zero breakthrough. This means geopolitical uncertainty supporting precious metals demand isn't fading, it's intensifying. But here's the third piece of evidence that ties this together. The mathematical comparison between gold and silver revealing how much further this move could go. In 1980, when both metals hit record highs, gold topped at $850. Silver peaked at $50.36. That's a ratio of 17 to 1. Fast forward to January 20th, 6 days ago. Gold hit 4,891. Silver reached 95.78. Gold was 5.59 times higher than its 80 peak, but silver was only twice its 80 high. See the imbalance? If silver kept pace with gold's gains, it should be trading around $280, not 95, not even today's 109. Historically, during crisis periods, that gap narrows. The gold to silver ratio compresses toward 20 to 1 or 15 to 1 as investors pile into silver as the more affordable precious metal. Here's the calculation happening in investment committees worldwide. $1 billion buys 200,000 ounces of gold at $5,000 per ounce, or 9 million ounces of silver at 109. Way more liquidity, potentially more upside if silver plays catch-up. According to market data, silver is up over 240% in the past year, while gold is up 85%. Nearly triple the gains. So we've established 3 ironclad pieces of evidence: a 6-year structural supply deficit creating real scarcity, gold breaking 5,000 as Trump's trade threats undermine dollar confidence, and a mathematical gap showing silver significantly undervalued even at $109. This is documented reality with numbers we can verify and trends we can measure. The market is screaming that something fundamental has changed in how global investors view dollar stability and precious metal scarcity. Understanding what's happening is important, but understanding what happens next determines whether your retirement survives intact or gets crushed by forces you didn't see coming. Here's where we move from what's happening to what happens next. And I need you to understand something crucial before we dive into the numbers. The targets I'm about to share aren't wild guesses or hopeful speculation. They're mathematical projections based on historical patterns, supply-demand fundamentals, and the specific catalysts we can see coming in the next 60 to 90 days. Let's start with what some prominent investors are already saying publicly. Robert Kiyosaki, author of Rich Dad, Poor Dad, and a longtime precious metals advocate, has set a target of $200 for silver. That's nearly double where we are this morning. Is he crazy? Is he just trying to pump his own positions? Maybe. But let's look at what CoinCodex, a financial data platform, is projecting based on technical analysis and momentum indicators. They forecast silver moving from around $100 to $130.12 by February 23rd, 2026. That's 28 days from now, a 29% gain in less than a month. Now, technical analysis isn't magic. It's pattern recognition. And the pattern CoinCodex is identifying shows silver in a parabolic uptrend, where each pullback gets bought aggressively, pushing prices to new highs faster than the previous leg up. If that pattern continues for another 4 weeks, 130 by late February is actually conservative. But here's where the real calculation comes in. The target that nobody's talking about publicly, but that the math absolutely supports. Let me walk you through it step by step. Bank of America, one of the largest financial institutions in America, published a forecast projecting gold will hit $6,000 per ounce by spring 2026. That's just a few months away. Not years, months. They're not some fringe newsletter or conspiracy website. They're a massive bank with teams of analysts studying precious metals markets full time. So let's assume Bank of America is right and gold reaches 6,000 by, say, May. That would put gold about 20% higher than this morning's 5,085 level. Significant, but not crazy, given the momentum we're seeing. Now remember the gold to silver ratio we discussed earlier. During normal times, it trades around 50 to 70 to 1. But during crisis periods, when investors are scrambling for hard assets, it compresses toward 20 to 1 or even 15 to 1. This happened in 1980. It happened during the 2008 financial crisis. It's a reliable historical pattern. If gold hits $6,000 and the gold to silver ratio compresses to just 20 to 1, not even the extreme 15 to 1 we saw in 1980, that puts silver at $300 per ounce. Let me say that again. $300 per ounce based on historical crisis ratios and Bank of America's gold forecast. Now, do I think we get to 300 by spring? Honestly, probably not. That would require an extreme level of panic and dollar rejection that we haven't quite reached yet. But 250 to 275? That's absolutely in play if gold continues towards 6,000 and the ratio compresses to 22 or 23 to 1. Think about what that means for someone who buys silver today at $109. A move to 250 represents a 129% gain, more than doubling your money in 4 to 5 months. And that's not based on hopium or wishful thinking. It's based on gold doing what a major bank says it will do, and silver doing what it historically does during dollar confidence crises. But there's a more immediate catalyst we need to focus on. The February to March window when Trump's Canada tariff threat could become reality. Remember, Trump said if Canada finalizes its trade deal with China, 100% tariffs hit immediately. Well, according to the terms that Canadian Prime Minister Mark Carney announced, that China deal is set to activate on March 1st, 2026. That's 33 days from now. So we've got a ticking clock. Either Canada backs down and cancels the China deal, which seems unlikely given how aggressively Carney has been pushing back against Trump's pressure. Or Trump backs down, which also seems unlikely given his track record. Or the tariffs actually happen. If those tariffs go into effect, even for a few days or weeks before negotiations resolve things, the economic shock will be enormous. 60% of our crude oil comes from Canada. Supply disruptions mean higher gas prices immediately. 85% of our electricity imports could face tariffs, meaning higher utility bills. Lumber, steel, aluminum, all of it suddenly costs twice as much. The inflation spike from 100% Canada tariffs would be instant and massive. And you know what happens when inflation spikes unexpectedly? Precious metals explode higher as everyone scrambles to protect purchasing power. So here's my specific forecast for the February to March window. If we get any indication that those Canada tariffs are actually going to be implemented, silver runs to $120 to $135 before March 1st. That's the panic buying phase. Then, depending on how quickly the situation gets resolved, we either consolidate around that level or push even higher toward 150. This isn't fear-mongering. This is game theory. We're watching two governments play chicken with an enormously consequential trade relationship. And markets don't wait to see who blinks. Markets price and the risk now, which means silver prices today, this morning at 109, are actually undervaluing the probability that this Canada situation escalates. Now let me address the elephant in the room. What about a crash? Silver rallies are famous for violent corrections. In 2011, silver hit $49.82, came within pennies of its 1980 record, and then crashed to $11.74 by 2020. That's a 76% collapse over 9 years. So yeah, silver can go down hard, and anyone telling you it only goes up is lying to you. The question is, where does it correct TO, and how do we position ourselves to benefit from the upside while protecting against the downside? Here's what the data tells us. Since that March 2020 bottom at 1174, every single pullback in silver has been a buying opportunity. Every single one. The pattern has been consistent. Silver rallies to a new high, pulls back 10 to 20%, then rallies to an even higher high. Rinse and repeat for nearly 6 years straight. Why? Because the structural supply deficit we talked about creates a floor under prices. Industrial buyers need silver. They can't just stop making solar panels or electric vehicles because silver got expensive. They have to pay whatever the market demands. That buying pressure supports prices during corrections. But here's the critical point. We're now in what technical analysts call a parabolic phase. Prices aren't climbing steadily anymore. They're surging vertically. And parabolic moves always end with sharp corrections. The physics of markets demand it. You can't go straight up forever. So the question isn't if silver pulls back, it's when and from what level. Does it top at 130 and correct to 100? Does it hit 160 and correct to 120? Or does it run all the way to 200 plus before the correction hits? Nobody knows for sure. Anyone who claims they do is selling you something. But here's what we can control. Our positioning, our risk management, our strategy for navigating this incredible opportunity without getting crushed when the inevitable correction happens. If you're an American retiree or near retiree watching this right now, here's my specific recommendation. Own 10 to 15% of your portfolio in physical silver. Not silver ETFs, not silver mining stocks. Physical silver that you can hold in your hand or store in a secure vault. American Silver Eagles, Canadian Maple Leafs, or reputable bars from mints like Pamp Suisse. Why physical? Because if the dollar crisis thesis plays out and we see real systemic stress in financial markets, you want assets that exist outside the banking system. Paper silver is ultimately a claim on silver. Physical silver is silver. There's a huge difference when confidence breaks down. But don't just buy and hold blindly. Set stop losses. Not mental stops, real stops that force you to act. My recommendation is if you buy physical silver now around 109, you set a mental line at $95. If prices fall back below 95 and stay there for more than a few days, something has fundamentally changed and you need to reassess. That gives you $14 of downside protection while keeping you exposed to potentially $100 to $150 of upside if we hit 250 by spring. That's a risk-reward ratio that makes sense. You're risking 13% to potentially gain 129%. Those are odds I'll take all day. Now, timing matters. If you don't own any silver yet, should you buy today at 109 or wait for a pullback? Here's the harsh truth. Trying to time a bottom in a parabolic market is nearly impossible. Yes, silver might pull back to 100 or 95 before running higher. But what if it doesn't? What if the Canada tariff situation escalates this week and silver gaps up to 125? Then you're chasing prices even higher. My suggestion is to scale in. Buy 1/3 of your target position today. Buy another third if it dips below 105. Buy the final third if it dips below 100. That way, you're not trying to perfectly time the market. You're systematically building a position that averages out to a reasonable entry price. And here's something almost nobody talks about: the psychological benefit of already being in the trade. When you own silver at 109 and it runs to 130, you feel like a genius. The confidence helps you hold through volatility. Versus sitting in cash, watching it run from 109 to 130 to 150, feeling like an idiot for missing the move, then panic buying at 160 right before the correction. I've seen that pattern destroy portfolios over and over, so act now. Scale in, set your stops, and then focus on the bigger picture. Because here's what this is really about. This isn't just a silver trade. It's about recognizing that the financial weather has changed. The rules that governed our economy and markets for the past 40 years are shifting. We're moving from a world where the dollar was unquestionably dominant and America's economic relationships were stable to a world where those things are increasingly uncertain. That doesn't mean America is doomed. It doesn't mean the dollar goes to zero. It means we're entering a period of volatility and transition where the old playbooks don't work as well, where a classic 60-40 stock bond portfolio might not protect you the way it used to, where holding 10 or 15% in hard assets like silver and gold isn't paranoid prepping, it's prudent portfolio construction. The people who will thrive in this environment are the ones who see the pattern early and adjust, who recognize that silver at $109, gold at $5,000, and Trump threatening Canada with 100% tariffs aren't random disconnected events. They're symptoms of a larger shift in how global capital views dollar stability. And the math we've walked through today isn't complicated. 6-year supply deficit plus short squeeze plus geopolitical uncertainty equals higher prices. Gold at 6,000 by spring equals silver at 250 to 275 if historical ratios hold. Canada tariffs on March 1st equals massive inflation shock equals silver at 120 to 135 by late February. These are noble catalysts with predictable effects. Not guarantees, but high probability scenarios based on documentable patterns and measurable fundamentals. So where does that leave us this Monday morning? It leaves us with a choice. We can ignore what the market is screaming at us. We can pretend that silver at 109 is just noise and everything will go back to normal soon. We can keep our entire retirement in dollar-denominated assets and hope that dollar confidence magically restores itself despite mounting evidence to the contrary. Or we can act. We can take a measured, strategic portion of our wealth and put it into assets that benefit from dollar weakness rather than suffer from it. We can position ourselves to potentially double or triple a slice of our portfolio over the next 4 to 6 months while managing downside risk through stops and position sizing. The opportunity is real, the risks are manageable, and the window is now, before silver runs another $20 or $30 higher and it becomes even harder to build a position at reasonable prices. This is our moment, our chance to get ahead of a major financial transition that most Americans won't see coming until it's too late. Because by the time silver hits $200 and CNBC is running specials about the precious metals mania, the easy money will have already been made. The smart money is acting today, this morning, at $109 while everyone else is still trying to figure out what just happened. Don't be the person 6 months from now wishing you had paid attention to what the market was telling you on Monday, January 26th, 2026. The calculation is complete. The conclusion is clear. Silver at 109 with visible catalysts pointing toward 250 by spring. The only question left is what you do with that information.